Hey there, Econ friends. Thanks for joining another lecture. In our last recorded lecture, I gave an overview of the three key financial statements. In today's lecture, topic 5, we're going to go into a bit more detail on the balance sheet. Okay, by way of review, the three big personal financial statements were the balance sheet, the cash flow statement, and the budget. The balance sheet my friends, describes your financial position as measured by your net worth, that critical number. And remember that a balance sheet is a snapshot document. It reflects your current state effective a particular point in time. It's a snapshot document, okay? The balance sheet typically, if you build one, when you review the one that I built in the templates, it's going to have three components. It's very simple. Three components to a balance sheet. Component 1, assets. Those are the items that you own that have some value. Component number 2, liabilities. Liabilities are defined as the money that you owe, typically tied to debts from, let's say, credit cards or loans and mortgages, although sometimes your liabilities could also include, unpaid tax or, professional services that you've used. If you have, if you use an estate planning attorney to put together your will, that he's going to send you his bill next month. That's a liability. So again, assets, what you own, liabilities, what you owe. And the key number, the key metric, your net worth, is the difference between your assets and your liabilities. So net worth is equal to your assets minus your liabilities. And ideally, my friends, that number is positive and it's growing bigger and bigger and bigger every month, which is why you're going to be running these balance sheets every month, okay? Let's talk a little bit about assets in some detail. In terms of the way that assets are classified, we can group them into 4 categories. And the grouping of the assets on a balance sheet are primarily tied to the assets' underlying characteristics and uses. We're going to start off with liquid assets. And as you know, liquid assets are financial assets that are held in the form of cash or that can be easily converted to cash with little or no loss of value. So, cash that's on hand, the money that's stashed in the usually the top drawer right side underneath your underwear, money in your checking account, savings account, money market accounts that can be easily pulled out, cash. Liquid asset. After liquid asset, we move to household assets, also known as personal property. And this refers to all of the tangible movables, all the property in your daily life, your car, your laptop, all the stuff that you own, your stuff. This is considered a household asset. It's important to understand with household assets that most household assets over time, they depreciate, which means that they decline in value. In fact, almost all household assets will decline in value or depreciate the moment that you purchase them and put them in use. Okay? If you buy a car for $20,000, you buy it new, the minute that you drive that car off the lot, that car is no longer worth 20, it's worth less. It depreciated. When you're doing your balance sheet, it's important that you record all your assets at what's called the fair market value, or the FMV. The fair market value is what the asset is currently worth were you to sell it today. So it factors in that decline of value when a product gets old and depreciates. Do not record your assets at the price that you paid for them. Do not record balance sheet assets at the price that you paid for them, because if you do that, you're going to be overestimating your assets, and that's dangerous. In fact, now's a good time to tell you about the idea that I prefer when you do these things, because sometimes valuations are going to be kind of vague. I always prefer conservatism in my valuations. So it's always prudent to, if there's ever any doubt, err on the low side of asset values and err on the high side of liability values. That way your net worth is a conservative number and you won't be caught off guard because you misestimated. Okay, so you have your cash assets, your household assets. You also have, in your next category, investments. And investments are, we've discussed in the investment plan, stocks or bonds or mutuals or real estate. Those are assets that you acquire in order to grow in value over long periods of time. Okay, so those are your investment assets. The holdings in your retirement account, the holdings in your mutual fund, brokerage account, those are investment assets. And the final category of asset would be real property. Real property is a tangible asset, but the key to real property is that it's immovable. So it typically refers to either the land or the houses that you own. This is in contrast to personal property, which is still tangible, but is used in day-to-day life and you can pick up and is movable, okay? So real property, typically land or houses. There it is. One final point about assets, actually two final points. On your balance sheet in the asset part of it, we typically in finance indicate the assets from the most liquid to the least liquid. So when you put your category of asset, you should go liquid assets or cash, then household, then investments, then real property. So you always report your assets on your balance sheet from the most liquid to the least liquid, okay? One final point, on your balance sheet, you indicate, you report any asset if you own it. It doesn't matter how you purchased it or financed it. Sometimes people will say, well, I bought the car, but I took out a loan, so I'm not going to list it. No, you still list it because the car is still an asset. The loan, on the other hand, what you owe, is going to be indicated in the liability section, which we're going to cover next. So liabilities are generally classified. We know that liabilities are monies that you owe, debts that you owe. Liabilities are generally classified according to their maturity. We typically call liabilities current liabilities if they are due within a year, and we call liabilities long-term liabilities if those debts don't have to be paid until a window of a year or longer. So current liabilities coming due in the next year, long-term liabilities beyond a year. Note that your liability obligations should be recorded on your balance sheet at their current payoff amount. And much like assets, you're going to record your liabilities from the current to the long term. So just as you put liquid assets down to less liquid assets on the asset side, you start on top of your liability side with current liabilities and then go to your long-term liabilities, okay? The big number of all this is net worth. And net worth, this crucial number, is the value of your total assets minus the value of your total liabilities. And at the end of the day, your net worth is basically the number that represents your actual wealth, the actual wealth that you and or your family has accumulated. Your goal is to increase this number over time. Now, ideally every month, but sometimes you have up and down months depending on the markets. But over the longer window of time, your goal is to increase that net worth number because that is basically becoming more wealthy, okay? You should also be aware of a condition known as insolvency. And insolvency is defined as a state or a condition in which your net worth is less than zero, meaning that you are basically, you have net liabilities in excess of your net assets. I offer this to you as a definition, not, my friends, as an aspiration, because you do not want to be insolvent. Finally, and I'll leave it at this, when it comes to your net worth, you should not just expect, but also plan and live in a conscientious manner so that your net worth number increases over your life cycle. So you now know your assets, you know your liabilities, you know your net worth. Let's talk a little bit about changes in your balance sheet. In other words, changes to your net worth. And the basic idea here, my friends, is that you can only improve your net worth by increasing your assets or decreasing your liabilities, or both. That's the only way you can do it. Again, this is why net cash flow positive is so important, because it's net cash flow positive that allows you to either acquire an asset or chip away and pay down a liability. It's important to note also that generally, if you spend all your income on products that are not assets, meaning if every dollar that you make, you spend on just basic consumption, whether it's required consumption like rent and food, or variable fund consumption like trips to Vegas. It's critical that you understand that if you spend all the income you earn on just consumption and not on assets, your net worth will never change. So that's why sometimes people will say, oh, well, I live by a balanced budget. And that's great, but that's only part of it. Balanced budget just means that you're spending the same that you're bringing in. Net worth asks a little subtle question based on that, which is, but what are you spending on? Because if you're just spending on consumption items, your net worth, it will not increase. It increases when you spend your money on assets, okay? Because if you invest in assets, particularly in investment assets, your balance sheet will change over time because your investments will grow in value. And again, this is why it's crucial to generate net cash flow positive every month. Every month. Net cash flow lets you increase your asset base without increasing your liabilities by, for example, purchasing investment assets, or it allows you to decrease your liabilities by taking that net cash and chipping away at your mortgage debt or your credit card debt or your student loan debt. Both of those, increasing asset numbers and dropping liability numbers, will increase your net worth. The final thing I want to point out, which ties to an earlier point, note that purchasing personal property will probably not improve your net worth. And as an addendum to that, over time, will probably decrease it. So if you're spending all of your income on consumption, not only will it not increase your net worth, but over time it will probably decrease it because the assets that you buy will depreciate in value. Ultimately, you have to make the trade-off between spending money on immediate consumption goods or on long-term investment assets. I hope that you understand those trade-offs, and I hope that you understand that because of depreciation, spending on just straight consumption today not only will not increase your net worth, but over time will actually drop it because the assets are going to fall in value. Whereas it's predicted that if you invest in assets like mutual funds and stocks and equities, you're going to grow over time. That's critical. Finally, the last thing about this, when we get into the statements, including the balance sheet, we get into a little thing called ratio analysis. Personal financial planners are very big on ratios. If you've taken accounting, you're familiar with this idea. We can consider ratios to be shorthand numbers that we can compute very easily based on our statements. Those shorthand numbers not only tell us some information, but tracking those ratios over time helps you to understand if you're making progress. So what are those key ratios? Well, the main balance sheet ratios include the following. Number one, what's called the liquidity ratio. And your liquidity ratio is your total, your total liquid asset divided by your total current liabilities. Okay, your liquidity ratio is your total liquid assets divided by your total current liabilities. This is a crucial ratio. This basically tells you, do you have enough money right now to cover all your debts coming up? You have enough cash to cover your bills. If that number is telling you the wrong story, you have got to adjust rapidly. Your solvency ratio is your total net worth divided by your total assets. This one is less popular. I put it there so you have it. Liquidity ratio, you have to track. The solvency ratio, it's less popular. I put it there in case you want to know it. Your debt to asset ratio, ratio number 3, your debt to asset ratio is your total liabilities divided by your total assets. This is similar to the liquidity ratio, except it's taking all your liabilities, both current and long-term, and all your assets, both cash and non-cash. It's basically saying if you had to liquidate everything, could you handle your obligations? And the final ratio, a little bit more of an arcane one, but I still think a good one, is your investment asset ratio. And this is defined as your investment asset figure divided by your total assets. This to me is a very underutilized and very important ratio, because look what it tells you. It tells you out of all your total assets, what proportion is investment asset. Meaning, out of all your total assets, how many of those are deployed in such a way as to increase your wealth over time. Ideally, you want to see this number, this investment asset ratio, grow over time. It's going to be hard when you're younger because you're just starting out and you have a small asset base and you're trying to build up an oh shit fund and get your checking account ready and chip down on debt. But once you stabilize your financial situation, you want to make sure that you're investing appropriately in long-term growth assets. This investment asset ratio gives you a proxy as to how successful you are over time. So my friends, we now know what balance sheets are. You know the components, you know the sub-definitions, and you also know how to run a few interesting ratios to test and get a sense of your direction over time. Thanks for taking the time to watch this. I'll talk to you soon.